David versus Goliath, where David is really being viewed as the more responsible and sustainable form of capitalism, and Goliath, some people would say, is the tougher and more extractive version, if I can put it that way. We've got participation from multiple geographies, all the way from the US to Europe, UK, Switzerland, Africa, the Gulf, India, of course, and then also Hong Kong and Tokyo and Japan. So we're delighted. We welcome everyone here today. We're delighted to have you all here. And I think the wide participation also is reflective of the very deep interest that the whole world has in this topic, and how high the stakes are. This Cloud Chat is BuzzOnEarth's official launch of an entire series of Cloud Chats that they will be curating on sustainable and responsible investments and ecosystems, covering the most crucial issues, challenges, and opportunities that we face, especially as the meaning of measurement and accountability and transparency and performance, and Sanjay, you will relate to this, valuation, morph in front of our eyes as we speak into something very different with far-reaching implications. My name is Mahesh Krishnamurti, and I have the distinct pleasure of being the moderator tonight. And I'm very much looking forward to that. I would also like to thank, on behalf of BuzzOnEarth, Yes Bank for their partnership and for their support and for their pioneering work that needs to be recognized. They've been a leader, they've been a pioneer, they've been a visionary in the space that is all about responsibility, sustainability, impact, social impact, and environment. And I think they've been an early adopter of all of these aspects of running a business, and they've been involved with the World Bank, the International Financial Corporation, the IFC, very, very active, one of the early signatories to various frameworks, including the climate-related task force on reporting, many other aspects, including the principles for responsible banking. They were one of the early signatories, Global Reporting Initiative, one of the pioneers in the India green bond market. So the list goes on. So we're very grateful for Yes Bank's support. I would also like to mention the fact that BuzzOnEarth is a leading sustainability hub dedicated to mainstreaming sustainability. And BuzzOnEarth's focus is on the sustainability edge as the new growth imperative and formula for success. BuzzOnEarth has audiences in some 190 countries and has been rated among the top 10 sustainability YouTube channels globally, and has been #1 in India in 2020. And it was also rated one of the top 30 sustainability blogs globally by FeedSpot. So with that, we now come to the main event. I don't know which corner Goliath is in and which corner David is in, but that doesn't matter. And we'll let the audiences figure out who they think, at the end of this, who they think David was and who they think Goliath was. But let me start off. It gives me great pleasure to introduce the two speakers today. Let me start with Professor Tensie Whelan. It's T-E-N-S-I-E, but it's pronounced Tensie with an O. I just want to be very clear on that. Tensie is Professor of Business and Society at the NYU Stern School of Business, and also the director there of the Center for Sustainable Business. Tensie has been a leader in ethics. She's been a leader in mainstreaming sustainability, mainstreaming environmental and sustainability priorities and issues and challenges, and has played a very significant role in engaging the business community in order for them to essentially integrate impact and tangibly demonstrate the benefits that accrue from that sort of a focus on an impact mission. Tensie has been on the boards of some very, very renowned organizations, Unilever, Nespresso, Aston Martin. She was also the president of the Rainforest Alliance. Tensie has been featured extensively in some of the best known publications and media out there, including the Harvard Business Review, Fortune, Forbes, Crain's, Wall Street Journal, Financial Times, the list goes on. I am delighted to have Tensie, and I'm also actually delighted to mention the fact that Tensie is also an advisory board member for BuzzOnEarth, and recently, very recently, published yet another article in the Harvard Business Review on a topic that she has pioneered at the center at Stern, which is all about return on sustainable investment. And I'm hoping that all those who registered are indeed in receipt of that article. It just came out, and if not, please let us know, and we'll make sure you get a hold of it. Sanjay is a very unique person. I would say first and foremost a very good human being, beyond being an outstanding venture capitalist. Sanjay is founder and managing partner of Blume Ventures, and has the distinction of having founded Blume as a very unique homegrown Indian VC company, and that's no small feat. And it's one of the most distinguished and one of the largest India-based venture capital firms, unlike many others who've come from the US and extended into India with deep pockets and major resources. Sanjay can also claim to have, I think, raised the largest fund just before the pandemic hit us, some $120 million, if I remember correctly. I think you closed that sometime in February or March, a record for an India-based and homegrown venture capital firm. Sanjay's expertise is really B2B deep tech, and covers Internet of Things, SaaS, software as a service, ML, deep tech, artificial intelligence, and all the rest of it. And the Blume portfolio includes some very well-known names, and I think you hear a little bit more about those this evening tonight, including Yulu and a couple of others. I can tell you that I've met quite a few VCs both in India and from outside India, and Sanjay is somebody who I think pays extra care and attention to his portfolio founders, his portfolio companies, and the founders. And I think he's somebody who's very, very nurturing and very supportive, and had the vision several years ago when Blume was founded to really try to fill that niche, that gap between angels and very early stage financiers and large VCs. And I think you filled a very, very utilitarian gap there, and have been able to take that and grow it into something quite amazing. So with that, let's get right into it. Just really quickly, we will have about 45 to 50 minutes of discussion, and then I'll open this up to Q&A from the audience. And let's see how that goes, and I hope that it works out and it's technically sound as well as we go forward. So we've set the stage. We're looking at a scenario where capitalism seems to be morphing into something a little bit different than what we've been used to in the past. And I'm wondering whether it's fair to say that the flow of capital, the allocation of capital, is a little out of sync with what the future portends. And so let me start off with Tensie. Tensie, do you think impact capitalism is a moral imperative, or do you think it's a business imperative? Where do you sit on that spectrum?
Well, first let me say that it's a delight to be here with everyone, and I want to congratulate BuzzOnEarth for this series. I'm sure it'll be full of terrific speakers, and look forward to attending some of them myself, and delighted to be a member of the advisory board. So in terms of impact capitalism, first of all, let's define what do we mean by that, because we could mean many things. So I'm just going to use a very simple definition, which is we mean that capitalism should have a positive societal impact, right? It should create value for society rather than extract value and convert it solely into financial benefit for a select few, right? So that's the definition I'm using. I'm sure other people could use them, but so when I'm answering the question, that's how I'm thinking about it. So is it a moral imperative or a business imperative? Well, I'll be a good academic and say it's both, right? We clearly are seeing that the decisions that business makes has an outsized impact, negatively and positively. On the negative side, we see an impact on climate change, through the emissions of our doing business. We see growing inequalities through how capitalism has been structured through the focus on short-termism and so on. But we also see the benefits that capitalism has brought to the world in terms of reducing poverty, of creating opportunities for people, creating goods and services that they need. So I believe that as we recognize the negatives of our current form of capitalism, those business leaders who really focus on creating positive solutions for people will do well financially as well as do the right thing morally.
Okay, thank you. Sanjay, any thoughts on that from your perspective, from the world of venture capital?
Again, I'd say, Happy New Year to everyone, to the both of you, and to all the listeners and everyone who's tuned in. It's a pleasure to be here and to partner with you again, Mahesh. And I will go with Professor Whelan here. And luckily for me, she's taken both positions of David and Goliath. And said, I've been an ex-consultant, so I'll give you the consultant's answer that it's both. And one thing I'll say is that. Much like women entrepreneurship, I think I have always observed that it makes most sense when you really bring it front and center, right? As opposed to saying that, okay, we're a venture capitalist or we're angel investor, and we'll do 90% investments and we'll do 10% impact investments. It doesn't work like that, right? I think the everything from the valuations to the value creation. Whether it is impacting jobs and saving consumers money and you're therefore putting more hands in the value of in the hands of customers, really comes back to impact. I think it's really an intersection of two Venn diagrams, and that intersection is quite large. So I'll say it's both. I would agree with Professor Whelan there that it's model and it's business. And I think impact can be defined in different ways. I think when most people think of impact, and we'd love to go deeper into this in the discussion, think of it has to be necessarily maybe not for profit or has to be something in the social sector. But you can just see the industries that have disrupted, everything from mobility, shared mobility, have not just created new jobs, but have created new means of livelihood, and there are different ways of impact, and some of those are also happen to be the largest valued unicorns. So I think they can coexist, right? And we would love to see that intersection becoming larger.
And what you just stated, Sanjay, dovetails beautifully into, and what Tensie just mentioned earlier goes beautifully into the whole question of what is impact and what some people refer to as additionality. So, and Sanjay, you just mentioned that if a business is started and they create new jobs, that is impact. And I would agree at one level that is impact. I would love to hear Tensie's views on that. My question to you, Tensie, is that a part of running a business and therefore not incremental or additional impact? Or would you, in your world, as you see impact, include that as socially impactful?
Absolutely. I mean, I think when you're looking at what makes a company sustainable, what makes it have impact, it's an environmental, it's a social, and it's a governance, to use those, ESG investing approach. It's all three. And so I think one question, though, is what type of jobs are you creating? How are you treating your workforce? It doesn't mean that all jobs need to be high salaried jobs, but what is the spread between the CEO's compensation and the employee's compensation? Are employees given a path for career development? If employees need to be laid off, how are they laid off? We're doing some research actually around jobs, and sort of one of the challenges I think with our current form of capitalism is that we tend to look at labor, in fact, as an externality, as something that we need to reduce in order to improve our returns. And that's really with a short-term focus. So we want to, outsource it, offshore it, automate it, do everything we can to get rid of it, pay it as little as possible, et cetera, in order to deliver more to the shareholder. And I think that that's a problematic approach. I think actually creating good jobs is something that can actually help and the company perform better. And a lot of research is demonstrating that actually investing in your people, which is, I believe, an impact element, but investing in them well also means that you're going to have better customer service. You're going to have higher retention. You're going to have higher productivity, all of which can translate into better financial performance.
It's interesting because if you take that and look at it contextually, one could argue that in a developing nation, the creation of jobs is right at the bottom of Maslow's pyramid. Whereas in a more developed or evolved market, if you will, the creation of jobs is something that is a little bit more of a luxury. And I don't mean to trivialize the idea of creating jobs, but the idea of making the job environment better, improving pay equality, those types of ideas, I think, are not basic enough in an emerging market such as India, just as an example. But anyway, and that can be a different discussion, and we can even include that in one of the subsequent chats that we have in this series. But you know, I now, Tensie, you sit in if not the global financial capital of the world, one of the leading global financial capitals of the world, New York City. And you are with NYU Stern, which is a business school which talks all about profitability and how to make money and how to get rich. And yet, at the center for sustainable business, you've developed something called return on sustainable investment, the ROSI model. Talk to us a little bit about that, and in terms of how it applies, or how it applies differently between large organizations and potentially startups. We have a lot of entrepreneurs. We have a lot of dreamers listening to us here today, and you know, we want to give them hope, and we want to give them inspiration, and we want them to know that they're on the right track and that they will get funding and that they will succeed. So is there a way of taking your methodology and your framework and leveraging it in both contexts?
Absolutely. Well, so first, to support what Sanjay said earlier around the fact that a lot of companies that are focusing on solving societal challenges or opportunities are creating new business models, new business opportunities. That innovation, how sustainability is driving innovation and growth, is very much a part of return on sustainability investment for companies. So we've developed a methodology called ROSI, Return on Sustainability Investment. And we're looking at mediating factors that drive better financial performance when you embed sustainability in your company, whether it's a large existing company or a startup. And sustainability can drive, as I said, innovation, but also operational efficiencies, employee engagement, productivity, as we were talking about. It can drive risk mitigation. It can drive better sales and more customer loyalty. It can drive supply chain resilience. So a series of positive benefits. And we've been working with all types of companies, from small apparel companies to large agribusiness companies like Cargill, to identify that return on investment. And what we're finding pretty consistently is that we see positive financial benefits accrue. So we worked with some automotive companies, and one of their sustainability strategies is to reduce waste. And typically, companies approach that as just a compliance issue. But actually, when you think about it, waste is an efficiency issue. You're buying more than you need to dispose of the extra stuff, right? And pay to dispose of that generally. So for automotive companies, they are recycling their paint and solvents. When they recycle their paint and solvents, they no longer buy the virgin stuff. They no longer pay to dispose of it. And actually they were selling it. So they had a revenue stream. So there's an example of how you can look at a company and figure out how you might better improve your financial returns. And I would also, just to go back to your point about, well, good jobs are a luxury that may be challenging for India. I would just say, you know, in looking at some of the work that we've done in agricultural supply chains, you benefit if your supply chain pays your workers decently and gives them benefits, because if you're talking about seasonal workers, you get back the better workers who work harder because they want to be there, because they are getting treated better. You have less theft, you have less problems because people are more aligned with the company, and you have less risk in your supply chain of something blowing up and really having, creating a reputational or a regulatory problem for you. All of that translates into financial benefit for the company, as well as improved working conditions for the farmers.
So Tensie, would it be reasonable or fair to say that Rosie then helps companies, both large and small startups, understand what impact areas to measure depending on what business they're in, and also how to scale that impact?
Yes. So the actual, you look at what are your key material sustainability issues, environmental and social. You identify what practices you could put in place to address those, and then you can figure out how to monetize those. And I actually would say that for a startup company, at the beginning is the time to figure that out, to see where you can create additional financial value for yourself through adopting more sustainable practices from the beginning. Absolutely.
And it provides methodologies for accurate measurement.
Yes. So we have, and that's all available on our website. It's a work in progress. We're learning all the time, and we're developing materials for different industries, but anybody who's interested, feel free to reach out to us.
Okay. No, that's great. That's great. And I hope everyone's received the latest article that Tensie has published in the HBR. So Sanjay, how does all this sound to you? Is for example, a Rosie model something that would be relevant and appropriate for your environment, where I know Blume has investments in multiple sectors across the board: healthcare, retail, commerce, agri, fintech, etc. Is there scope for something like this? And has Blume envisaged proactively looking at investments through this sort of lens?
Sure. I know I've got to admit that I would love to take a deeper look at Rosie also. Investors and entrepreneurs always want to present a rosy picture. And it's interesting, right? We talk about ROI mainly. Let's just take a step back, right? If you look at the world of venture capital and angel investing, we've got multiple stakeholders. We're almost like a marketplace, right? You've got LPs, limited partners, investors on one side, endowments and other educational institutions. And then, of course, startup founders on the other side. Now, investors, the LPs really care about, it's really show me the money, right? Which is ROI, return on equity in the capital markets. ROTI, which is return on time invested, right? You think about your time is almost as important as your capital. But I think sustainability is becoming more and more important. Maybe I'll just illustrate this answer with a couple of examples. We have in our portfolio, I know this founder through my InMobi days. I'm a small angel investor in a company called InMobi, and Amit Gupta used to be the founder of InMobi, and now he started a company called Yulu, which is really aiming to be the #1 electric vehicle, two-wheeler company, but they may morph beyond that. Now, he moved from building a B2B ad tech business, which is very, I wouldn't say just for profit, but it's very technology driven. And yes, there is impact in that. But at the heart of Yulu was basically that how do you reduce noise, air, traffic pollution in India? That was the core when they started, right? And the Prime Minister in India and the government happened to launch the whole Smart Cities initiative. So at its core was always, it's not just what answer we get to, but how we get to it. Can we partner with the Smart Cities program? Can we develop more sustainable alternatives? Everything from a simple two-wheeler bike, which obviously has zero emissions, to EVs and different types of EVs. And now they've partnered with a strategic, which is an interesting segue of a David versus Goliath, right? And this is public news. Public news, that is the Bajaj, which is of course one of the doyens. And it's really interesting and heartening to see corporates saying that, let's partner with startups because they're the innovators, right? We might claim we do innovation and we do innovation, but we focus on, on scale, and let's partner with the startup and, see how we can lease our vehicles to them, the basic core, and they make the EV vehicles. And it's an interesting partnership. So it's a David and Goliath partnership. But also at its heart was they've created jobs. They might partner with factories, and they're basically reducing emissions, right? Because can you reduce the number of cars on the road? So that's Yulu. So that's one of our investments, and we're very proud to do that. And we never thought of, okay, we've done 90% for-profit investments. Let's make an impact investment and to show investors. I think the idea is that may turn out to be one of the best investments. Just one more example, Tricog, which is a very interesting company set up by a cardiologist and 2 PhDs from the US who came back. And what they do is they basically integrated hardware and a software AI platform that at its core basically can predict the likelihood of a heart attack from happening and reduce that time from 45 minutes to 5 minutes. So you've got a platform that can sit atop a ECG machine, and then basically has a team of data scientists and cardiologists and who can predict, right, and say, yeah, there's something happening here, and in 5 minutes you have an answer, right? Now, their core API, their core KPI, key performance indicator, is not the revenues, but the millions of lives that they've saved, right? Now, they also happen to be sitting on 5 million data patient sets and be doing well in terms of the annual revenue run rate. But at their core, they're designed to save millions of lives, right? So, and both these are some of our best companies, right? So I want to illustrate that when you were asking me to think of, I was just thinking before the call, which companies I could quote. These are front and center, right? These are some of our best companies that also happen to deliver impact.
Sanjay, those are great examples, Yulu and Tricog, for sure. I mean, I think we would all agree that those are initiatives and investments that are impact investments. To what extent do you have LPs, limited partners, who turn to you and say, okay, you're raising a fund for 100 million, 150 million, and guess what? We would like 70, 80 million of that to be allocated to impact startups and innovators. Are you seeing that? Are you sensing that at this point? Is there any sort of a tsunami that you sense is coming your way from that standpoint?
It is happening more and more. Sometimes you think, you're 99% investor, you're 1% diplomat or politician as well, because you've got to manage multiple stakeholder interests. But it's happening from the DFIs, right? The development financial institutions that are actually saying that, but do it because it's good and it creates value, right? Not just to do good. I think that's an important point. You're also seeing it from, especially in certain sectors, like in the energy sector and the automotive sector. I mean, look at some examples. For Yulu, for example, they're going to raise their next funding round. And when I look at the list of the investors, I'm pleasantly surprised. You see the likes of automotive majors, right? Like a BMW Ventures, and you see Airbus Ventures. And it's fantastic. And I think what it does is it creates a ripple effect, because you have corporate India, at least let's talk in our sphere, say, wow, if they're looking at it, we should too, right? I think Anand Mahindra, Rajiv Bajaj here, the Munjals have taken a fantastic step in that direction. It also helps in that sector. But you always need one person to start, right? And I think we are seeing LPs drive and encourage us to do that. And I think it is important. If you look at a balanced scorecard, right, to use that business school term, it is becoming more and more important. And what it does is that if you have one major investor that comes and encourages you to think along those lines, then you might as well update your balanced scorecard and then share that, make that your standard. Right? I think we're all about continuous improvement, and if that makes sense, then we'd rather make that a scorecard for all our investors and not just for the impact investors.
Mm-hmm. Okay. So I'd like to spend a little bit more time talking about measurement of impact. I think it's a crucial area. I would imagine that somebody like Sanjay is, who's used to looking at internal rate of return and net present value and other forms of valuation and return measurement, would be saying to himself, I've got an IRR of 20 on investment XYZ, and I've got an IRR of 15 on an impact investment. And I don't see that extra incremental 5 that would at least bring me to the 20. And so I think the world at this moment is challenged, and I'm sure Tensie can shed some light on this in terms of how impact can be measured. I know we talked about ROSI a little bit, but you know, beyond ROSI, are there any global standards, Tensie? I mean, there's the Global Impact and Investment Network, and they have something called IRIS, which is their own internal reporting mechanism that they've come up with, which seems to be the gold standard at this point, which is sort of the gap, or the IFRS to impact accounting, that gap in IFRS to financial accounting, right? So, but it has a long way to go. So where are we in that spectrum, vis-a-vis being at a place where we're all comfortable and we can say, hey, listen, this is what the financial return is, and guess what? This is what the impact return is. And so A plus B equals whatever. Hopefully 1 + 1 = 5.
Right. Well, first, let me just start with what are the different types of investment strategies, because they have different risk-return ratios and different ways to assess them from an impact perspective as well. And I think it's important for our audience that we're clear about those, right? So you have your traditional socially responsible investing, which is basically about negative screens. It's generally a public market approach. I don't want to have coal or nuclear weapons in my portfolio, right? And your impact there is very easy. No coal, and you know, making sure that that's true throughout the holdings. That type of investing typically has not performed that well, because it's about sort of you're losing diversification in your portfolio. Increasingly, people are now moving to what's called ESG integration, which is looking at companies that could be a coal company, it could be a food company, it could be a variety of different companies, but looking at how they perform on what are the material, environmental, and social and governance issues for them. There we have SASB, the Sustainability Accounting Standards Board, that creates standards for that to determine what is material by industry. Global Reporting Initiative also. And we were seeing those two organizations and others come together around through the World Economic Forum and through other venues to see how they can develop sort of a set of standards around what is material for companies to assess their ESG performance. With that strategy, ESG integration, that's generally, not always, generally public markets as well. And there you can have a strategy of only investing in the top performers or investing in those you think that are going to do better, because that's where you might see the financial value improve. And then you have your impact investing, right? And there you have two types. You have market rate impact investing and you have concessionary rate impact investing. And market rate impact investing, you're looking to maximize your financial returns. You're generally looking at it in the private markets. It generally has risk, just like regular investments do. Some will return really, really nicely, as Sanjay said, and some will be duds. And that's kind of what you're dealing with, right? But you're looking there both for returns and for the impact. And there, you're going to be less focused on what the material ESG issues are and more around what is the impact that the company is stating it's in business to achieve. As Sanjay said, saving 5 million lives, or whatever the particular, creating, reducing water use in agriculture by X, improving or reducing greenhouse gas emissions through e-vehicles by X. So there's definitely through IRIS and other ways, but really through, I think, just focusing on what your goals are, you can assess that. And then the concessionary impact investing, the impact investors are saying, you know what, it's more important to me that I get the 5 million lives saved, and I'm willing to take a lower rate of return. I don't want it to go below X, whatever that number is. And you'll see a number of institutional investors with that kind of strategy. In some cases, for example, foundations may take that type of strategy, or wealthy family offices may take that type of strategy. And that's perfectly acceptable too, right? And so they'll now be very, very focused on, are you delivering on your societal impact indicators, as well as the minimal financial indicator they're looking for?
Yeah, it's interesting because at the end of the day, wouldn't you agree that it's much more about the lens through which an investor is looking at an asset class? Because impact investment is not an asset class. It's more about the lens that you're looking at these investments through, right? And so I think so. At one extreme, you've got the private equity you've got listed companies, you've got fixed income, green bonds, debt, exactly, all the way down to, senior debt, senior loans, subordinated loans, all the way down to the grants. And so the expected return, so at one extreme, it's market rates, and at the other extreme, it's concessionary rates, if you will. So an investor who is approaching these different investment or asset classes with different lenses, obviously will then have different expectations on the return on that investment. Now, if I happen to be a startup and an entrepreneur who is absolutely zealous about doing a ULU or a TRICOG or doing something in the healthcare space that is all about social impact, to what extent is that concessionary? To what extent does that social impact element become concessionary? So would a venture capitalist like Sanjay decide that it is too concessionary for it to become a unicorn or for it to be scalable to the extent that his limited partners might want?
Sure. So, I'll answer that through a historical lens. I think if you look at it about 10 years ago, I mean, we started Blume, both Karthik and I were in the US, and we came back and we started Blume in about 2011, 2010-11. These were really different worlds, right? The world of impact investing and, let's say, the investors who invest just in consumer brands, in India is a very vibrant market, right? Today, the millennials don't want to, drink the same beer or eat the same yogurt that their fathers or mothers did, right? They want their own brands.
I'm coming there.
And you really didn't, and those worlds never met, right? So if you look at it today, we've got, for example, there's some agri-tech funds. And there are funds, believe it or not, that look at space tech, right? Now, what is interesting is when these startups are approaching at us, we've, like Omnivore, for example, right? I mean, Mark is a friend, and we've done now 3-4 co-investments together. We're about to do our 4th. This was not happening about 5-10 years ago. And the important point here is that impact funds would typically have the impact LPs, and we would go to different LPs. And now you're seeing the common LPs. You actually are looking in one sense, through different lenses, but it's also the same lens, because what you're essentially saying is, you may have an agri-tech focus. Let me give an example. We have invested in a space tech company who are juniors of my engineering college from BITS Pilani, that basically are going to set satellites up into the sky. But the imagery that they come up with is going to be used by large agri-tech companies, by natural resources companies, to make better decisions that impact, that lessen, that improve climate change, that reduce pollution of different kinds, right? Now, that is massive impact. Of course, there's going to be value that's created because you are going to be able to improve the yield from your crops, reduce crop disease, but you're also impacting lives, right? I mean, they may be, you might say, actually, this farming land is not as productive, and from that satellite image, you should be somewhere else. And earlier, the lenses would be very different. An agri-tech fund, which is heavily backed by impact LPs, would look at that same company, and we would, but we've never co-invest. Today, we're co-investing together, right? So the point is that I think there's a meshing and there's a blurring of those lines in a positive sense. I think to use this word, and Tensie, we have a teenage son who's applying to colleges. So I'm looking at his to the US as he applies, and this word of doing it for the greater good, I think is becoming more and more important. Even a traditional tech venture capitalist like myself is much more aware of that. I think our younger team members are aware of that. And I think those lines are blurring, and we're seeing more co-investments, more syndicates, and we're looking at more of it from a joint lens.
Okay, and so as I mentioned earlier, we have lots of aspiring entrepreneurs, Sanjay, listening to you, and Tensie. What are the absolute musts that a business plan must have from your perspective, and what are the absolute no-nos that should be completely excluded and left out of business plans from your standpoint, in order to get some sort of early seed stage funding?
Sure. I'll take I'll take a crack at it, and I'll talk about the fundamentals that have not changed, in the last 10, 15 years, and maybe some things that are becoming more important, bringing the impact lens. 2020, it feels like we're still in 2020, but the last year was tough partly because of this. You and Tensie know each other, and there's a rapport, and you and I know each other, and thanks to that, I feel like I know Tensie. But it is difficult to assess a founder at the end of the day on Zoom, right? In 45 minutes or in 1 hour. So what we do is, when we look at the investment lenses, before trying to find out what they're really going after. For example, if let's say somebody wants to create an agri-tech company that is really going to reduce the incidence of diseases, let's say in crops, we really want to understand the passion and why they're doing what they're doing. That's very important, right? What's that sense of mission, purpose? It really comes back to the core of what he or she is doing. That's one. I think a large enough problem, a large market, finding customers or users that will really alleviate a pain point, and either they will pay money for it, or it's going to reduce, it's going to have some long-lasting benefit to them. I think those are fundamentals of the business: how large the market is, how strong the team is, how well they work together. I think the second part of it partly goes into impact, right? When I said why they're doing what they're doing, is this, if you're an angel investor, is this a company that is going to give a 5x to you multiple? And, if you've invested 100,000 and you made $1 million, that's great. Everybody exits. Or they're really trying to create long lasting impact, right? For example, if you think about, let's say urban, like Yulu, right? If they're going to try and get to 5 million vehicles on the road, fantastic. But if the mission is to reduce, traffic and noise and air pollution in India, at a fundamental level, and in terms of that, therefore, get so many bikes on the road, convert, the number of non-EVs to EVs, then that's also a noble and a model mission, right? In terms of financial mission. And if you do that and you're really passionate about it, then the money flows. So I think impact in one sense does come in, right? Whether we don't think of, oh, that's an impact company and there's a non-impact startup. So I think the fundamentals are very much the same. That is this a massive space? Is this going to create value? Is this going to help the consumers? But is it also going to impact the world and make the world a better place in that sense, right? And you could, have a social media platform that also makes the world a better place. Or you could have a space tech company that beams imagery and helps farmers make better choices, also impact. So I would say the fundamentals haven't changed, but I think the role and the value and the appreciation impact has changed.
So could that also mean potentially that it doesn't have to be the next unicorn or the next decacorn, or scalable to that extent? Can it be an enterprise that maybe achieves $100 million in revenue, but that delivers significant impact and good returns?
Yeah. Well, if it gets to 100 million in revenue, it is almost surely going to be a unicorn. But I think you're right. That is a second order effect, right? I think, we don't necessarily buy into founders and say, I want to create a unicorn, back me, but it's more, this is the value that we're going to create, a massive value, hopefully globally. I'll tell you, and I think Tensie can relate to this. Indian entrepreneurs are ambitious, sometimes over ambitious, and they want to take on the world. And we're almost like, okay, conquer this market first and then take on the world. But the fact is that today founders want to go global, and it's a wonderful thing, right? They don't just want to say, okay, I'm going to create this best product just for India. They want to, but all we tell them is, hey, listen, it's a project map, break it into bite sizes, and do India in phase 1. But in some B2B markets, the US may make the most sense to go after first, right? So deliver on that ambition, but do it in bite sizes.
And as you're doing with Esg Ventures, and taking them early into Silicon Valley and things like that.
That's
Tensie, millennials. What are they doing to us? What will they do to us? How will they influence the brands, the way we look at financial markets, capital markets, the way we evaluate investments, returns. What exactly is going on? And I'm sure you've got some insights into this.
Millennials, and actually the generation coming up after them, is even more focused on these issues. So yes, millennials, all of the surveys that we see, and I teach them as well, but all of the surveys that we see demonstrate that millennials are very interested in shopping in line with their values. They're very concerned about climate change. They're very concerned about inequity. They're concerned about diversity and inclusion issues. So there's a series of issues that they are not only concerned about personally, but are concerned about brands offering solutions, whether they're as a customer or, just as importantly, or perhaps even more importantly, as an employee. Because what I hear from companies more and more is, as there's a war for good talent, they are finding that to get that good talent, they need to be a reputable company that does have a purpose, as Sanjay said, something that millennials feel good about working for. And millennials, unlike baby boomers, I think baby boomers were brought up to say, all right, we do our work during the day and we do good at night, with the money we make doing well during the day, doing business during the day. And for millennials, they don't see it as needing a trade-off. They see it as the two things should come together, both in their professional lives and in their consumption. And this isn't true for all millennials, of course, but we see that skew far more for that generation. As an example, we've done work looking at actual consumer purchasing of consumer packaged goods in the United States using data by a company that collects all of our CPG data at retail, from mom and pop stores to Walmart. And we looked at 36 of 40 CPG categories. That are things like shampoo or deodorant or cookies or chocolate. And what we found, and we looked at 73,000 products. And what we found is that 55% of the growth, and this also goes back to your investment thesis, right? 55% of the growth over the last 5 years in CPG came from sustainability marketed products. And we saw in some categories 100 to 150% growth. We also saw a 39% premium along with this. Now, how to tie that back to millennials? Millennials were the group with the largest, the purchasing per capita of these products, although baby boomers and Generation X have more disposable income at the moment. So they actually spent more dollars, right? But what we could see is that the millennials were the ones with the highest number of millennials were the ones who were really interested in these across educational categories, across income categories, et cetera. So I think, and there's also a good international study done by GlobeScan and BBMG that looks at markets like India and also finds that what they call the aspirational consumer is very significant in India. I think it's something like 55%, very interested in shopping in line with their values.
So Tensie, could this mean that structurally, as we look at consumer products that have impact, services that have impact, that appeal to millennials, brands that create that emotional connect, does this mean that structurally we are therefore going to be looking at longer return cycles? Does it mean that we have to take on a longer term perspective and engage in capitalism that is not as extractive, if you will, and that is more sustainable? Does this mean that? And if it means that, then does that also mean then that you've got the large mutual funds and all the CalPERS and all the big guys out there with the deep pockets? They're going to have to start looking at things a little differently. And how will that ripple down all the way down to that startup that's on the ground in the thick of it?
Well, I think looking at two CPG companies would be instructive, because that space is one where consumers are very focused, and so you can see change happening. So Unilever, as an example, big commitment to sustainability, 100% sustainable sourcing, supporting, I think, 500,000 small producers, having their environmental footprint, getting rid of plastic packaging, et cetera, et cetera, et cetera. In addition, they've gone on a buying spree because, as we all know, big CPG companies are not that innovative. So they've been buying a lot of what once were startups who created sustainable products, right, that they can now bring into their family of brands. Ben & Jerry's being one of the most well-known, but there's a lot of smaller brands that they've bought. And I think there's a lot of opportunity for small CPG startups to get acquired by these companies. Now, on the other side of the coin, we look at Kraft. Kraft has doubled down, and it's owned by 3G, which has very much a traditional approach, which is basically to extract value, right, and do financial engineering around the product. So no investment in R&D, no investment in sustainability, no acquisition of new products that are more sustainable, and doubling down on things like Oscar Mayer bologna, which nobody really wants to eat anymore. So what do we have? We have a company, heading into bankruptcy. Right. So I think there's a real interesting sort of cautionary tale. And of course, that's not the only reason why Kraft is suffering. There's a variety of things. And it's not the only reason why Unilever is doing better. So how does that trickle down? Well, when Paul Pullman came in to Unilever to start all of this, he actually looked to pick his investors. He wanted investors who would go on that journey with him. And I think that for startups, they want to find investors like Sanjay who are going to support this journey to have more of an impact. They're going to want to look for buyers like a Unilever versus a Kraft who are going to align with their vision if that's what they want to do in terms of where they're going, or if they want to continue to create their own company. They're going to, again, want to look for investors who are interested in that long-term play, as you said. So I think that long-term approach, given the challenges that society is facing, are not short-term problems, they're long-term problems, and investing in change requires that broader long-term strategic approach if you're going to perform well financially as well as have positive impact.
Great. Sanjay, anything you wish to add quickly, a minute or two on your perspectives on the impact of millennials from your vantage point?
Absolutely. In one sense, even while Tensie is path-breaking and has cutting-edge research, in one sense, we're all Goliaths and the millennials are the Davids, right? In one sense. And I'll give an example. Like a couple of 5 years ago, you would walk into a board meeting and you'd see all your plastic bottles lined up, and with your label, and you just go and sit in the board meeting. And this literally happened 2 years ago. When as the average ages got younger and millennials have come into Blume and founders have come in. We'd come in and somebody would say, why do you have all these plastic bottles inside Blume, right? And while you saw that, you never did that yourself. And we just chucked, now we don't have any plastic bottles inside Blume anymore. We can't, right? You in a sense want to feel guilty, but it took a millennial to tell us that. If you look at the car manufacturers, whether it's the Audi e-tron, or look at no further than Tesla, I look at millennials who will pick up, a juice or whatever it is, and really look at the labels. They want to know what's going inside before they open the cap, right? Now today we just saw that Bira, for example, has got Kirin beer from Japan invest in it, because the same example, the same illustration analogy that Tensie was talking about, they know that the innovation is going to happen from startups. Why would maybe a Japanese conglomerate really need to come up, because they know that this is where innovation is going to happen. So I think it's very positive to see corporates partnering with startups. And the fact is that this is a very long-term game. I think there's no bones about that. We get into the Q&A, but when I always tell startups is that this is a long-term game. This is not about getting rich and getting rich quickly. This is about creating long-term impact. And if that's the goal, then all the stakeholders around you win, right? Whether be it your users, customers, long-term shareholders, and your employees. So this is a very long-term business.
Yeah, and so if it's a long-term business, then obviously it's going to affect your return cycles as well, right? Over time. So I guess at some level, everyone gets normalized to a new longer-term horizon in some sense, as they're evaluating different asset classes through the impact lens, presumably, right? So, okay, so what I'll do is I'll take, we've got some questions. Let me see how judicious and clever I can be in selecting the questions. We've got a few that I think are quite interesting. Now, one very specific question is, what hardware and software is available to make it easier to measure and analyze the key data points? Can either one of you cite a specific and simple example where that's been possible?
Well, so it depends on what you're talking about. You know, are you talking about at a corporate level where you're trying to understand the impacts of your work? Or are you talking about at an investor level? But you know, if you're looking for ESG data,
I think Nancy, just to clarify that, I think you can put it into the corporate level context.
At the corporate level, okay. So at the corporate level, you'd want to do first a materiality analysis, which there's a number of consultants that can help you do that, where you and you can use as a guide, as I mentioned, the Global Reporting Initiative or the Sustainable Accounting Standards Board, to look at what would be material ESG issues for your company. But you also want to do outreach to stakeholders, because you may have a blind spot in terms of what's important. And so you want to hear from workers, you want to hear from nonprofit organizations, you want to hear from government regulators, and you want to be thinking about this in the long term, as you said, Mahesh. You know, you want to be thinking about where are things going to go, not just where they are right now. And then you do a matrix to sort of identify what are your priority issues, which you either have an impact on or that has an impact on you. So if you're an agriculture company or food company, you have an impact on climate change through the emissions of your processes, but climate change is also going to be having a big impact on your productivity and your supply chain. So how do you address that would be really critical. There are various consultancy groups. All of the big four work on these issues. There's smaller consultancies like the Business for Social Responsibility that will help companies. If you're a small startup and you don't have the budget for that, there's plenty of online material around how do you design a materiality matrix, how do you build that into your sustainability strategy. BSR, Business for Social Responsibility, has some of those materials that are free of charge. Also, depending on the industry, a lot of industries have their own guidance around this. And then there's places like the Ellen MacArthur Foundation, which has materials around circularity in terms of how do you reduce your waste and how do you move more to a circular economy. And then there's, you know, big platforms like SAP that has platforms around managing your supply chain to make it more sustainable and more efficient. So there's actually a plethora of tools out there for companies.
Yeah, actually, right at BuzzOnEarth, there are some capabilities as well in terms of materiality analysis and so on. Right. But you know, it's confusing, as you would well agree. It's very confusing. What is impact? How do you measure it? And what's additional and what's incremental and what's run-of-the-mill business operations and so on and so forth. So I think it just requires a lot of synthesis analysis.
Well, and again, you know, just to, when people talk to me, they complain, and understandably, you know, hey, we have 5 different or 10 different ESG data providers asking us for different information. All of our the brands that we supply to, they all have their own questionnaires. I'm supposed to be answering all these things. It's a full-time job for 5 people. So what do you do about that? Well, the main thing is to understand in your business strategy, again, what are the key impact areas? Because it should be part of your business strategy. It shouldn't be a checklist off to the side. It should come very clearly from, if you're creating medical devices, what kind of impact does it have on people's health, right? I mean, that's going to be a key area that you're going to look at. But along the way, medical devices, for example, use a lot of energy. So what are you thinking about in terms of designing those medical devices so that you reduce your climate impact? Because that is a big impact that medical devices may have, right? Rather than, and then when you're answering all these questionnaires and focusing on all these data requests, you can say, we're focused on these 10 KPIs because they relate back into our business strategy for these reasons. And they tie back into what SASB and GRI also, but we've pulled out what's most important for us and our stakeholders. So.
Okay. Sanjay, we have an audience member who is really quite keen to understand how Blume Ventures values sustainability and impact considerations. Do you have some way of measuring it, valuing it very specifically?
I'll give a more indirect answer because we are not a traditional impact investor. I think we look at impact as, I'll answer it this way. I think sustainable impact means that it goes hand in hand with long-term impact. And, we're looking for entrepreneurs who really want to create something over 10 or 20 years, right? I'll give you an example. Sometimes it also has a bit to do with age. Like our Pixel co-founders are all of 22 years old, right? In one sense, it's quite scary also when you say, wow, you're backing startup founders that it's their first job and only job and they're doing this right out of college. But they're also doing it because they are in it for such a long-term game. I mean, these guys are robotics expert, or they've been passionate about space in the age of 10, and they're not doing this, to get rich quick. They're really doing this for a long time. So I think that's one lens of looking at it. But a different way, I think Tensie made some very interesting examples, right? It's almost like not a checklist, but it's really like a framework and saying that not only how are you creating long-term impact, but can you create it across multiple dimensions, right? Is there long-term financial impact? Is there, are you helping, are you constantly, you go back to Intel and think about Moore's law, right? Are you constantly doubling the impact across multiple dimensions, across, with your users, with your customers, with your partners? When you think of something like Tesla, right? While of course, Elon has his own sort of personal sort of quirks. Just think about the number of jobs that's been created, not just in one dimension, but across, about with Tesla factories in space and automotive. And it also, I think what's interesting is I think we also, success breeds success, right? I mean, today when people think about Tesla, they think about the shareholder value, but you also say, hey, this is a cool company. I want to work for a EV or sustainable company that also draws the best talent, right? That's also aspirational. I think, in one sense, people say, oh yeah, impact is great. Let's do it because you got to check the box, versus no, that's where the coolest companies are going to come from. And when you see an entrepreneur that's created shareholder value come from that industry, that's going to say, wow, I want to do it, but I also want to do it in that segment, which is creating sustainable energy. So I would say that I don't really have a stock answer to that question. But one way would like to, you want entrepreneurs who are going to create very long-term impact. I think long-term impact and sustainability go hand in hand, right? Because that's what sustainable means, right? It's going to be, there's going to be longevity, there's going to be sustainability. This is not a one-trick pony. This is going to be, defined across the century, if you will.
And I agree, Sanjay. And I think to the extent that we're going through a metamorphosis in some sense, where transparency, accountability, measurement of impact, and therefore valuations, the way all of these are looked at is I think going to morph into something very different.
So I just want to, because you talked about it, let's look at a company like Zomato, right? I'm sure Tensie is also familiar. I mean, we are not direct investors in it. We have indirect stock through one of our companies. This is a private company where the founder makes all the financials public, right? And now you've created jobs where you have, of course, the two-wheelers, the delivery folks who, in one sense, has created a sense of livelihood because they lease those two-wheelers, but they have a sense of pride. If you have private companies that are making the financials public, I think that's quite interesting, right? Because you're basically saying, okay, this is the new benchmark. Now all the other private companies start saying, hey, maybe we need to do that too, right? It's taking a stand. And I think it's very interesting because this has been the secret private world of private equity and venture capital. And you have a founder who is owned, of course, partly by InfoEdge, which is a public company, but there's no obligation to do so. And I think it's quite healthy in one sense. Why not make it public, right? So you're taking a stand, sustainable stand of a different kind.
I mean, that's clearly a hallmark of the G portion of ESG, right? In terms of transparency and reporting and so on and so forth. We have an interesting question here that either one of you is welcome to grab. How do you sell investing in ESG to a CFO? And when I see this question, a large enterprise is what jumps to mind, because in a small startup environment, a CFO can also be a COO, can also be a bunch of other things. So Tensie, I'm going to throw this to you, and then have Sanjay take a crack at it as well. But how do you sell ESG, and is there a way of selling just the E or just the S and or just the G to a CFO or to senior leadership within a larger organization?
So the ROSI work that we do, and actually my article in HBR is exactly about this, how to sell this to a CFO. So using some examples, so we worked with a Canadian power utility, and in Canada, the government is requiring all utilities to get out of coal by 2030. This company asked us to work with them using our ROSI methodology to determine whether they should get out of coal earlier than that. So we worked with the CFO on this and worked to design ways to monetize the benefits to them, and we looked at a variety of different things. One was around talent, because increasingly, as we talked about, people do not want to work for, younger people do not want to work for a company that's invested in coal and sort of creating massive greenhouse gas emissions. But the other area that we looked at for them was cost of capital, because increasingly investors are punishing those companies. I'm going to use that word, but they're charging them more because of the higher risk associated with coal. So we were able to establish and work with the CFO to show him that his cost of capital was going to get higher if he, or actually, let me put it the other way, it was going to become lower for the investments that he needed to make if he got out of coal sooner, which was something he was going to have to do anyway. So why not go ahead and get the benefit reputationally and from a cost of capital perspective? So I think, you just need to speak the language of the CFO. One of the challenges we have is that sustainability people speak a different language than the CFOs. They'll speak GHG emissions as opposed to, hey, our GHG emissions, if we reduce them, we get energy savings cost. I'll give you one other quick example. Pulp and paper company was looking at price of water. They don't pay for water. This is in the southeastern United States. So the chief sustainability officer was trying to make the argument that they needed to reduce water use. And everybody said, why? It doesn't cost us anything. What he demonstrated is that because a pulp and paper company use a lot of water, to move that water around in the factory, they use an enormous amount of energy. And then they create a lot of wastewater that they have to pay to dispose of. So all of that free water was actually costing them $1.5 million per mill, right? So using that data, he's able then to talk to the CFO in the language that the CFO understands about operational efficiency. So I think that's, sort of looking for those types of wins in the language that the CFO understands that come back to, improvements around sustainability is what our ROSI work is about.
Okay. Sanjay, thank you for that, Tensie. Sanjay, I know you and I have talked about how to sell into a B2B enterprise at the enterprise level and things like that, how a startup can sell into a B2B enterprise. In your travels, in your investments and conversations, have you had to coach anyone or help them understand how, especially a small startup, how to approach a CFO level person, especially in a large enterprise?
Yeah, within the context of sustainability, or just overall?
Within the context of ESG.
Yeah, it's still fairly new, right? If you look at a lot of startups, I mean, they're just running on a treadmill to stay alive, right? And you're so focused on delivering. If you missed your last quarter's numbers, I mean quarters or months numbers, you just have to deliver on growth. So I would say that there's a lot of socialization and education and awareness also that's needed. I think case examples and anecdotes are sometimes the best examples, right? To give. So, and I'm just coming back to to Tesla or other companies like that. I think young founders often learn from or look up to look up to other successful role models, right? That have been successful in those industries. And one of the things we talk about is that don't approach this as as a vendor selection, right? So for example, if you're a startup and you're saying that, okay, we're just going to compete on price. Remember, if you get in easily, you'll also get out the door easily, right? That's not really a sustainable decision. Pricing is never sustainable. You can be just run into the ground. Nor is just competing on one or two features, right? What is the overall package? And, 2020 in one sense is quite interesting. I'd always tell our founders that, think about the boardroom of your customer, right? What's important to them. And this is where ESG comes in. Suppose ESG, sustainability, long-term impact is really important to them. And they're getting hammered, their stock is going to get hammered. If you're a startup and if you can show how you're going to help them, then you're going to be in that room, right? Put yourself in the shoes of the CFO, what's important to them, what's important to their mission, and see where those missions are. And I think what makes it easier, the young founders really care about that. They care about the mission, they care about sustainability. Again, Tansi, I was just going back to college essays. I see that even creeping in, coming into asking how a 16 or 17-year-old is going to see the world and how they care about it, which means that whether it's participating in a protest or really caring about climate change, they're learning that. They don't have to be taught that. So I think it's interesting. So the younger founders, I think, just get it. Some of the older ones are becoming more aware.
Okay, good. I think we are coming towards the close of this session. We're almost at 8:15. Sanjay, that may well have been your 1 minute wrap up and summary, but I'll give you a minute to do a little bit more by way of a summary and a wrap up if you like, and then I will turn it to Tansi to do the same thing, and then I will wrap up this session for all of us today.
Sure. I'll just say very quickly that sustainability means very long-term impact. There was recently a Indian company called Pubmatic that just went public, and when I moved back from the US in 2011, it was still around, and it had almost sort of flamed out. It was on the side, and it recently just did an IPO, and it took 14 years, which means that the venture fund, and I spoke to the founder in the Valley, had to extend the fund life twice because it's a 10-year fund, moved to 12 and moved. And actually, this is not an exception. This is this is regular. So my advice to the founders is that really, really think hard about what you're starting up and why you're starting, because at the end of the day, investors may come and go, I may take an exit and go, but you're really there at the front and center. So I think the founders are really out there to change the world and really care about what they're doing are the ones that are going to be successful and also drive impact of everyone around you. So I think that's a message, that really go out and make an impact, but really do something that you really care about.
Okay, thank you. Thanks, Sanjay. Tansi, over to you.
I agree wholeheartely with David/Goliath, Sanjay. I'm not sure where we ended up on that, but anyway, it's about if we're talking about those who are starting up companies, it's about being in it for the purpose that you believe in for the long haul, and thinking about the positive and negative impacts associated with that business along the way. I do see startups that have a fabulous environmental mission, for example, but they forget about how they treat their own people, right? So you want to be and don't necessarily treat them well. We've had a number of actually startups blow up in the United States about that. So as a founder, you want to be thinking holistically about your purpose and how your organization is going to support that purpose moving forward. And be as sustainable as possible in all material elements of your business strategy. And I do believe that will be a winning strategy, both with investors and customers and with employees. So thanks so much for hosting this.
Yeah.
Okay,
but
excellent.
Can I just make a point? Sorry.
Sure.
I would say, at a personal level, I think all founders and all of us, just remember, especially the young startup founders, that we are role models where our good behavior is being watched, but also bad behavior is being watched. I think we're role models, and I think that's the most important, that we are on stage, and let's also be good people, not because others are watching us, but because the right thing to do.
Excellent. Good. And thank you, Sanjay. Thank you, Tansi, for having spent some time with us today. BuzzOnEarth is very, very happy to have you and most grateful to have hosted you. I also wish to thank Yes Bank. And I think the talk will enable some of our aspiring entrepreneurs and committed entrepreneurs, especially those in the social impact space. I think it'll enable them to walk away with a bit of a spring in their step and with more inspiration as they tackle 2021, which I hope will be a much, much better year in every respect for each and every one of us across the world. And with that, I'm just going to wrap up by reminding everyone that this is the initial launch. This is the very first session, this is the premiere, if you will, cloud chat that BuzzOnEarth will be hosting in a series of cloud chats during 2021. And we don't rule out the possibility clearly of having both of you back at some point between now and December 31, 2021 to have further discussions. And I imagine there will be a lot of evolution and a lot of progress in just the next several months on this topic. And just the very wide audience participation that we've had today tells us that there's deep interest in this. So stay tuned. I want to thank all the participants, all the attendees. I apologize for the fact that I couldn't get to all the questions today. But for those who are keen to get responses to any additional questions that they may have, that they may not have been able to fire off to us this evening, I would request you to send those to BuzzOnEarth, to BOE, and we'll tackle those. So once again, thank you so much. Good luck to everyone. Best wishes, and we'll talk to you again soon.
Thank you, Mahesh. Thank you, Tensie.
Thank you, Sanjay. Thank you, Mahesh.